Now, beginning from New York City, Max Wolff, Senior Analyst and Chief Economist at Greencrest Capital, joins us once again on the show. Good morning, sir, or I should say good evening, depending on where you are in the world. Brazil is a unique situation. It was once worried about skyrocketing inflation. Now we're talking about back to the foreign exchange issue, the economy not doing terrible, but not having the double-digit growth that it was used to over the past decade or so. What's the major issue that government officials in Brazil are most worried about?
So thanks for having me. Always a pleasure to join you. I think Brazil is worried about a few different things. They're worried about a kind of rebalancing in the global economy coming as the Federal Reserve of the United States begins to put out a different understanding of what it's going to do going forward, also to change the unusually accommodative monetary policy that we've had for an unusually long time, with a really unusual guarantee here of permanently low interest rates, which is creating a de-risking. We're seeing some money return to the developed countries, having been deployed very successfully for the last really decade in a whole bunch of developing locations, Brazil being one of them, as well as there's a little bit of a fear of global slowdown, which makes Brazil particularly vulnerable, given Brazil's enormously powerful and important role providing the raw materials on which the world grows. So I think Brazil is interested in defending its locational power as a destination for international investment, as well as keeping the real strong and keeping the economy on track, because the relatively high growth rates are needed to lift a large segment of the population out of poverty and continue the promise of a better 21st century to its public.
All right, so there's quite a basket of issues for them to deal with. Let me try to break this down one at a time. Let's start with the Fed impact, because a lot of people are saying because the Fed rates have been at zero, a lot of this money people have taken overseas to invest overseas. Now, whether or not they begin the tapering process, has the impact already been felt?
Absolutely. So we've seen a lot of global distortions. The United States did three unusual things as regards monetary policy for the better part of half a decade now. So we cut our interest rates to near zero, about 0.25%. We then kept them there. We then guaranteed we'd keep them there. And then we took the eyes of the world off our interest rates and put them on our quantitative easing, and then hence your reference of tapering. So now people aren't even looking at the interest rates because they've been such a long time where they've been guaranteed to be basically near zero, less than zero if you factor even U.S. domestic inflation, low as it is. And so now people are beginning to wonder about the 2014 story, and after we're done taking the foot off the gas of quantitative easing with our tapering, what happens to interest rates? And that's beginning to make people question where they've been borrowing from the U.S. and deploying capital around the world, and Brazil is one of those capital destinations.
All right, the other issue is sort of this modest slowdown in the economy. Part of it, I suppose, is commodities driven, but a large part of it is because the global economy simply isn't growing as fast as it was 4 or 5 years ago. How much impact does that have on Brazil?
Significant, right? Because Brazil is also a major trading partner of the European Union, as well as Brazil is a major provider of raw materials that go into production for the United States and for Europe. And what Brazil is feeling, a little bit like many other developing countries, is a long structural weakness period in Europe, and likewise a long structural weakness period for the U.S. middle class. And what that means is that even though the United States and Western Europe only have about 10% of the world's population, together they do about 40% of the world's final goods consumption. And that means that when they have a long, tough period, which we've seen now for the better part of 5 years, it creates shockwaves into the global economy that may be partially offset by accommodative monetary policy, particularly in the U.S., but as that monetary policy stimulus gets withdrawn, we're beginning to see that.
I want to also ask you about the rest of the emerging markets around the world as well, specifically about Asia. There's been a lot of talk. You look at Indonesia, Malaysia, and Thailand, and these have been real hot spots. I don't want to forget about the Philippines as well. They've slowed. What's happening here? Is this a direct result of what's happening in China, or is it something else?
Well, the Chinese story is a big part of it. China is the engine of global growth and certainly the locomotive of the Asian growth story for the last 15 years or so. And partly what you're seeing here is knock-on effects from a feared slowdown in China. Now, it does look like the more dire Chinese forecasts were overtly pessimistic, and that China will chart a much better course than the sort of most pessimistic voices were calling for. On the other hand, there is definitely a slowdown, probably to more sustainable long-term growth trajectory in China. And again, the rest of the Asian markets are also dependent to some extent on consumers in Japan, the European Union, and the United States.
Just an amazing situation. You think about it, they go from 8 or 9% growth to 7 or 8% growth, and you have this big impact around the world. Max Wolff, Senior Analyst and Economist, Greencrest Capital, thank you very much for joining us live.